Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
All right, let's just dive right in. NVTS Semiconductor. We have to focus on this name because the recent volatility has been, well, extraordinary. Just on January 6th, we saw this huge social buzz, a ton of volume, and the stock spiked. What was it? An aggressive 12% intraday.
Pushed it right up to about $10 a share.
Exactly. And that's decisively above the Wall Street consensus, which is sitting somewhere around $8.28. So the core conflict here, as I see it, is this massive strategic pivot they're calling NVTS 2.0. They're making this very deliberate, very costly shift away from, the low margin mobile charger business.
The commoditized stuff, right? And they're moving toward these high-margin, mission-critical, wide bandgap applications. Think AI data centers, high-end EV infrastructure. So the debate is really this. Does this aggressive valuation, sitting at 27 to 49 times forward sales, does that justly price in this AI option value? Or is this whole thing just a fragile value trap that's exposed by, frankly, a massive cash burn and what looks like some executive skepticism? And that's the whole ballgame.
For me, my position is that this premium it's justified. It's justified by the future dominance of these new materials and, maybe more importantly, the technical short squeeze setup that's just coiled in the stock right now.
And I come at this from a completely different angle. I think while the technology story, the wideband gap revolution, is sound, it's unavoidable, sure. But the financial reality of the company completely undermines that premium. I'm arguing that the structural financial risks, made worse by that 53% revenue collapse and some very concerning insider selling, it just invalidates this extreme valuation. The stock price is defying gravity.
I see why you think that, but let me offer a different perspective on that premium. We need to frame this not as some traditional cyclical semiconductor play. This is a pure play investment in a fundamental technological, a material shift. The total addressable market for wide bandgap tech is projected to grow at a compound annual growth rate of 25% all the way through 2032. The market is pricing that in.
But at what price?
Well, look, the price-to-sales multiple is high. I'll grant you that, certainly. But it's not based on the trailing $10.1 million from Q3 2025. It's based on the immediate, almost existential need for gallium nitride and silicon carbide to solve the physical limits of old-school silicon. I mean, think about these high-density AI data centers. You have a server rack pulling 120 kilowatts of power. Silicon chips just can't do it. They can't manage the thermal density. They can't handle the high-frequency switching you need to get to 97% efficiency. They fail. They overheat. They take up too much space. GaN chips, they're smaller. They run cooler. They are the mandatory upgrade needed to make those next-gen racks even physically possible. So what we're paying for is this unique, unavoidable optionality. And that warrants a premium over, the diversified giants like onsemi or Infineon, where this tech is just one piece of a giant business unit. And what's more, this NVTS 2.0 pivot, it's financially painful, but it's replacing what I'd call empty calories, that mobile charger revenue with margins in the low 30s, with high-quality, high-margin revenue. The proof is that the gross margins have stabilized at 38.7%. Even with that 53% revenue collapse, they sacrifice volume for quality. That's the right long-term strategic move.
That is an interesting point, though. I would frame that margin discussion very, very differently. To me, that 38.7% gross margin is the central risk, not the defense. I'm sorry, I just don't buy that a hardware business with sub 40% gross margins deserves to trade at 30 times forward sales. Not in this interest rate environment. Let's look at the actual numbers here. The financial analysis doesn't just show a decline, it shows a precipitous fall off a cliff. A 53.4% year-over-year revenue collapse in Q3 2025. That is not a simple trough, that is the valley of death that institutional shorts are targeting, and rightly so. The valuation is completely unmoored from the current balance sheet. The company is trading at a 300 to 500% premium compared to the sector average of around 7.9 times sales.
The bears are not arguing for the company to fail. They are just arguing for valuation gravity to assert itself
If that multiple compresses to the industry mean of, say, 4 to 6 times sales, which is standard for a high-risk, low-margin hardware company, the implied stock price is realistically closer to $2 or $3. And we have to talk about the cash burn. The Q3 2025 net loss was $11.5 million. When you weigh that against their current cash of about $150 million, the runway is incredibly short. That leaves them barely 13 quarters of cash, and that's assuming zero growth and a stable burn. It means their execution risk is existential. Any delay in that projected 2027 revenue ramp, a ramp that's supposed to come from 2025 design wins, could just accelerate the cash burn and force a highly dilutive equity raise.
Okay. Let's pivot from the strict financials to the boardroom then. Because if the balance sheet looks tight, the management activity sends an even clearer signal, though I'll admit it's a contentious one. I acknowledge the persistent insider selling has created some real dissonance for the bulls.
Dissonance? That is an understatement. It is the single most damning piece of evidence against the entire bullish thesis. I mean, think about it. If management truly believed that this Navitas 2.0 pivot was some guaranteed path to a $20+ stock, why are they constantly liquidating? The CEO, Gene Sheridan, he sold, nearly $9.7 million worth of stock in May of 2025, and that was near the stock's annual lows. Then you have directors continuing to sell right into that little rally we saw in December. If they were so confident, why not just use a pre-arranged 10b5-1 plan to stagger sales at higher prices? Demonstrate some confidence? No. Liquidating shares during a period of maximum financial uncertainty, near the bottom, it signals a distinct lack of conviction in any near-term rebound. It really raises serious questions about shareholder alignment. It suggests to me that management saw the same valley of death that the short sellers see and just decided to cash out while they could.
I'm just not convinced by that line of reasoning. I think it conflates the personal financial planning of a few individuals with the massive, irreversible strategic shifts that the company is executing. And yeah, the optics are bad. I get it. But we cannot allow those transactions to override the sheer necessity of what they're doing. The pivot is mandatory, and operationally, it's brilliant. Just consider the geopolitical risks. They are actively reducing their reliance on the Chinese supply chain. They're securing Western supply chains through these costly long-term partnerships with global foundries in Vermont and Cyient in India. This move protects them from tariff risks. It positions them for lucrative U.S. government contracts, defense contracts, that require a secure domestic supply.
This move is expensive. It definitely contributed to that 53% revenue collapse you cited. But it is mandatory for long-term survival in this high-stakes industrial and military sector. The pivot away from mobile junk to AI data centers is foundational. It's mandatory, regardless of what some executives are doing with their portfolios.
I agree that the geopolitical diversification is strategically necessary. Of course it is. But that trade-off is creating a structural revenue headwind right now. The question isn't whether the pivot is smart in the long run. The critical question is whether they survive the interim cash-starved period before those expensive design wins start generating any real money. And let's turn to the technology itself. You're arguing for this deep proprietary moat, but how sustainable is that defense, really, against the giants who control the entire manufacturing stack?
The moat is deep, and it's defended by innovation that solved a critical early adoption hurdle. When GaN first came out, integrating it was complex. It required all these external drivers. NVTS solved this with their proprietary GaN-fast technology, which integrates the drive circuitry, the logic, and the GaN switch all onto a single component. This integration is proprietary, and it's crucial because it cuts down the component count and it eliminates the parasitic inductance that just kills performance at high switching frequencies. It lets their customers build smaller, faster, more efficient systems right away. That is the source of their premium, their technical edge. And furthermore, their fab-light model gives them tremendous agility. It's a huge financial advantage over these asset-heavy IDMs.
I mean, Navitas avoids the billions in capex and all the execution issues that are just plaguing companies like Wolfspeed, which is bleeding cash trying to build these massive SiC factories. Navitas is focused purely on design, on winning the next generation of architectures. They're collaborating with NVIDIA to push for 800-volt architecture in data centers, which is exactly what enables that 97+% efficiency.
That's a compelling point on integration, but have you considered how fast that moat is eroding? The giants are waking up, and they control the cost lever. Texas Instruments, for example, has moved GaN manufacturing in-house to their massive 200mm fab lines. That vertical integration, that scale, it creates a cost structure that NVTS, which has to rely on external foundries like global foundries, simply cannot match in the long term, not once GaN moves into higher volume, less niche applications. They will get squeezed on margin as soon as this technology gets wider adoption and becomes commoditized. And this brings us right back to the execution risk, which is time-sensitive. You cite the collaboration with hyperscalers, but qualifying for that world is notoriously slow, notoriously difficult. A design win announced in 2025, that typically translates to volume revenue in 2027 at best.
If there's a delay of just 6 months in that qualification timeline, which is a very common thing in this industry, they could burn through $30 million in cash. And given their cash balance of around $150 million, the math becomes terrifyingly tight. They are racing against the clock that is ticking down their cash reserves.
But the tightness of that math, that's precisely what fuels the bullish asymmetry right now, thanks to the massive crowded short position. We have to discuss the market mechanics here. The high short interest is the source of the potential reward. It skews the risk-reward ratio heavily in favor of the bull. We've seen, 52 million shares sold short as of late 2025? That's roughly 26 to 30% of the entire float. The days to cover ratio, which measures how long it would take for shorts to buy back their shares, it expands to 5 or 6 days during normal trading. That is the danger zone for shorts. The mechanical prerequisites for a violent short squeeze are absolutely in place. This is a crowded bearish trade. Any definitive catalyst, an unexpected industrial order, a clear data center qualification announcement, even just positive guidance, would light the fuse. It would force these massive short positions to liquidate all at once, creating a feedback loop that could drive the stock price vertical.
I'm just not convinced that a temporary mechanical short squeeze overrides fundamental valuation gravity. The shorts here aren't irrational traders, they're institutions, and they're responding to weak Q3 earnings and the sheer unsustainability of the premium. The spike in short shares from 40 million in October to almost 58 million in November happened for a reason. It happened because institutions analyzed the fundamentals and saw a target. The short thesis is grounded in cold logic. They are betting that the $130 million revenue target projected for 2028 will not materialize fast enough to outrun the cash burn. And if management is forced into that dilutive equity raise we talked about, selling new shares just to cover operating costs, well, that event provides the compression mechanism the shorts are waiting for. It forces the stock price down to that sector average of 4 to 6 times sales, and it wipes out the premium.
It is a bet against time and flawless execution, which, in the hyperscale industrial qualification game, is statistically a very safe bet to take for the short side. So to summarize my position, NVTS is a highly speculative instrument, yes, but it's one that is perfectly leveraged to 2 powerful secular trends: the physical build-out of AI infrastructure and global electrification. The high operational risk is matched by an equally high asymmetric reward. If this NVTS 2.0 pivot successfully bridges that revenue gap and they secure those big design wins by 2027, then the current valuation is going to look profoundly cheap in hindsight. And the sheer mechanical pressure of that crowded short position just adds a potential volatile accelerant to that whole thesis. And I would summarize by saying that I concur the thematic argument for wide band gap is entirely sound. The technology is indispensable. However, the financial picture is structurally fragile, and the burden of proof rests entirely on the company's shoulders. The extreme valuation premium, trading well above analyst targets, combined with the persistent red flag of insider selling, demands extraordinary caution. NVTS has virtually no margin for operational or strategic error. The bear case just rests on the inevitable pull of valuation gravity that follows any misstep in execution or timing.
It's clear the next 12 months are going to be definitive. We'll be watching the trajectory of that cash burn rate versus the intake of concrete new data center and industrial orders. Those factors will determine whether Navis 2.0 becomes a transformative growth story for the ages or just another cautionary tale of a promising technology crushed by the weight of commoditization and an overly ambitious valuation. We'll leave it to the listener to weigh the evidence.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.